Right now, trillions of dollars are being poured into artificial intelligence. Companies are building massive data centers at a pace never before witnessed. This is the physical, undeniable reality of the artificial intelligence revolution. This infrastructure build-out is real, it's necessary, and it's unprecedented. But here's the unsettling truth. Many of the companies leading this charge are spending money they don't have on projects that might be obsolete next year, all driven by a singular, intense fear: missing out. The question isn't just if AI will change the world. The question is this massive investment a foundation for prosperity, or is it the largest bubble humanity has ever inflated? Welcome to the Nerd Financial Path. If you are looking for the absolute cutting edge of financial thought, the kind of wisdom that separates the successful long-term investor from the speculative gambler, you have to read Oaktree Capital's Howard Marks. He is arguably the most respected voice in value investing and market cycles. He has a track record of identifying financial manias that is frankly terrifying. He sounded the alarm on the dot-com bubble in 2000, and he was ringing the bell on the subprime mortgage crisis in 2007. And right now, Marks has just published a memo that should be essential reading for every single person who owns a stock. Is it a bubble? Marks opens the memo with a profound statement. Ours is a remarkable moment in world history. A transformative technology is ascending, and its supporters claim it will forever change the world. To build it requires companies to invest a sum of money unlike anything in living memory. He shares that during his recent visits with clients, sovereign wealth funds, heads of large institutions, this was the single, unavoidable question. The fear is palpable. The numbers being thrown around are unprecedented. We are seeing valuations soar into the trillions, and capital expenditure figures are moving into the quintillions. But Marks is not here to be a simple pessimist. He's here to give us the framework to navigate this. Today, we are undertaking a full, deep dive into this masterclass on risk management. We're going to dissect his crucial distinction between the good bubble and the bad bubble, the psychological traps driven by lottery ticket thinking, and the specific financial mechanisms, the debt and the circular deals, that make this current environment potentially even more dangerous than the dot-com era. If you want to survive and profit from the age of AI, this analysis is mandatory. Let's get started. Marks begins by reminding us that the key to understanding a bubble is its regularity. Not in terms of timing, no one knows when the next one will start, but in terms of the progression it follows. It begins, naturally, with something genuinely new and revolutionary. AI absolutely qualifies. It captures the imagination, and the excitement is overwhelming. Then the early participants, the true believers, enjoy massive, staggering gains, the 20x, 50x returns that define the initial boom. This is the psychological flashpoint. Marks writes that those who are merely looking on feel incredible envy and regret. This emotional cocktail is toxic. It drives the second phase, where people are motivated by the fear of continuing to miss out, FOMO, and they begin to pile in indiscriminately. At this point, fundamentals dissolve. Investors are buying without knowledge of what the future truly holds. They simply assume that because the technology is great, the stock must be a bargain. The question of whether the price paid can possibly deliver a reasonable future return is ignored. Marks points out this phenomenon is always driven by the same force: newness. When something is new, history provides no frame of reference to temper our optimism. The future looks limitless. Every current valuation, no matter how high, seems cheap compared to the potential of a trillion-dollar industry. This is why, as he quotes the famous economist John Kenneth Galbraith, skeptics are dismissed. Past experience is dismissed as the primitive refuge of those who do not have the insight to appreciate the incredible wonders of the present. Marks is delivering a powerful rebuke to today's tech evangelists. He is saying that high prices are not the bubble. Excessive optimism and the suspension of disbelief, that is the bubble. The euphoria is about the application of human emotion to a great invention, not the invention itself. Here is where Marks goes from market watcher to economic historian. He introduces a concept that is critical to understanding AI's unique risk profile: the difference between a mean reversion bubble and an inflection bubble. A mean reversion bubble, like the 2007 housing crisis, is based on a financial fad. It promises great returns without risk. When it collapses, everything returns to the baseline, and the only lasting effect is destroyed wealth and lost time. It offers no societal progress. An inflection bubble, however, is rooted in genuine, profound technological change. Think of the steam engine, the telegraph, the railroads, or the internet. AI, Marx states, undoubtedly falls into this category. Marx draws heavily on the work of the economist Carlota Perez, who argues that these bubbles are not just random events, they are necessary. The speculative mania is functionally required to fund the installation phase. What is the installation phase? It's the period where the massive, often money-losing infrastructure is built. The capital needed to lay transcontinental rail, dig canals, or run fiber optic cables is so enormous that only the irrational exuberance of a bubble can raise it. The speculation compresses decades of necessary build-out into a short, intense period. The paradox, the central tragedy of the inflection bubble, is this. Inflection bubbles accelerate technological progress and create the foundation for a more prosperous future, and they destroy wealth. The world gets undeniably better. But the investors who provided the capital for the infrastructure, the ones who bought at the peak of the mania, are the ones whose wealth is incinerated. They are the financial fuel that powers the world forward. Your objective, therefore, is not to argue whether AI is great, but to avoid being the fuel. You need to profit from the deployment of the technology, not pay for its installation. This brings us directly to the first financial hazard, the winner-take-all trap. Marx uses Warren Buffett's classic example of the automobile. The car changed the world forever. Everyone knew it was going to be huge. Yet, over 2,000 car companies were founded. Only a tiny handful, like Ford and GM, survived and rewarded investors. For the vast majority, the greatest technological invention of the century was a financial bloodbath. Marx asks a profound question. Given the chaos, the regulatory uncertainty, and the speed of innovation, how do we know who the ultimate winners will be today? The key difference between the 1900s and today is that prices right now reflect the certainty that today's leaders are the guaranteed winners. This is almost certainly wrong. This leads to what Marx calls lottery ticket thinking. He details the absurd valuations we are seeing: startups with no product, or just a working prototype, raising multi-billion-dollar seed rounds at $10 billion-plus valuations. He cites one example of a high-flying firm where an early investor called the pitch the most absurd he'd ever sat through. Yet they invested anyway. Marx breaks down the terrifying math. If a company is valued at $10 billion, and an investor believes there is even a minuscule 0.01% chance it becomes the world's first $10 trillion company, the expected value calculation mathematically pressures them to invest. The potential payoff is so unfathomably large that the overwhelming likelihood of failure, the 99.99% chance of failure, is outweighed. This is not investing. This is pure speculation, where the goal is simply to hold a ticket in the hopes of a life-changing payoff. This creates a compulsion to bet on things that have an overwhelming probability of going bust. It's what drives valuations to astronomical, unsupportable levels, and it's a hallmark of the mania phase. The speculation is dangerous enough, but Marx identifies two major financial mechanisms that are amplifying this bubble beyond what we saw in 2000. Debt and illusory deals. First, the simple fact of the debt structure. The capital expenditure required to build AI infrastructure, the data centers, the chips, is enormous. Marx notes that technology changes faster than ever. A chip is outdated in 12 to 18 months. Yet, companies are issuing 30-year bonds to finance this construction. Debt demands stable, predictable cash flows. Marx calls the use of long-term debt for speculative, rapidly changing assets a profound mismatch and a telltale sign of market sickness. Second, the circular deals. This is arguably the most concerning aspect. Marx points out how the capital is being used to create an illusion of real, profitable activity. Here is the simplified mechanic. Giant tech firms, for example, Microsoft, Amazon, invest billions into an AI startup, for example, OpenAI or Anthropic. That startup then turns around and spends a large portion of that cash, often from the very same investment, to buy cloud services, GPUs, and chips from the giant tech firms. Marx highlights estimates that Nvidia could make as much as 15% of its sales next year from these kinds of non-cash deals. The money is literally being round-tripped to simultaneously book revenue for the large company and to inflate the valuation of the startup. Marx cites the parallel to the telecom bubble, where companies exchanged capacity just to book fake revenue. He asks, is the purpose to achieve legitimate business goals or to exaggerate progress? When the music stops, and the companies have to fund these purchases with real external cash, the whole system collapses. And finally, the Minsky moment warning. Marx notes we are seeing unhealthy credit behavior, including the use of off-balance sheet special purpose vehicles, or SPVs, to keep debt hidden from the books. This is exactly what was used by Enron and what fueled the 2007 crisis. When credit runs out and the cash demands become real, the magnified leverage from the debt ensures total ruin. Let's ground this in history as Marx always does. He looks to two perfect parallels that capture the AI mania: radio and aviation in the 1920s. The moment Charles Lindbergh flew across the Atlantic in 1927 was proof positive that aviation was a world-changing technology. Aviation stocks soared, becoming the high flyers of the era. But the enthusiasm was irrational. No one knew the true business model. From the peak in 1929, aviation stocks dropped by a staggering 96%. Radio was the same story. RCA was the Amazon of the 1920s, a technology everyone knew would define the future. Investors bought into the promise of the future at any price. RCA stock ultimately lost 97% of its value in the ensuing crash. And let's look at the internet bubble. Marx reminds us that Amazon and Cisco were fantastic companies that transformed the world. But their stocks still lost 95% and 89% of their value, respectively, during the crash. The lesson is absolutely clear. The technology is real, profound, and world-changing. But the price you pay for the stock is what determines your fate. If you buy into the mania, you are financing the future with your own financial destruction. Before delivering his final investment advice, Marx adds a postscript that he calls important to him personally. It moves beyond the stock market and into society. He states the outlook for employment is terrifying. While economists preach the gospel of productivity, Marx asks the fundamental economic question: if AI does the work of humans, who will have the money to buy the products? He worries that the elimination of millions of junior-level jobs, the entry points for analysts, coders, and professionals, will lead to a massive structural problem. He warns that if a handful of billionaires on the coasts get rich while millions lose their livelihoods, it will result in severe social and political polarization that could threaten the stability of the entire system. This is a risk that investors must factor in. So, how do you invest now? Marx is not telling you to sell everything and hide. His advice is nuanced. Avoid leverage, play through equity stocks, not debt. In a market with high uncertainty, you need the asymmetric payoff of a stock. The one massive winner will reward your portfolio and cover the losses of the many failures. Debt only gives you fixed interest, which will never cover the defaults. The moderate position. Marx concludes that you must not go all in because the risk of ruin is too high. But you must also not stay all out and risk missing one of the greatest technological steps forward in history. The final, balanced advice is to take a moderate position, applied with selectivity and prudence. The market is currently fueled by a great invention and an old, dangerous emotion: irrational exuberance. Be intelligent. Be cautious. And remember that market cycles punish those who forget that fundamental truths always apply. After analyzing Marx's thesis on the inflection bubble and the dangers of circular deals, what is your take? Are you buying into this specific framework? Or do you think the AI trajectory is truly different? Let me know where you stand in the comments below. If you like the video, please take a moment to click that subscription button right now. Your support keeps the Nerd Financial Path running. Thanks for watching, and I'll see you next time.